This is chapter 12, our last chapter, intangible assets. So we're going to cover here in this chapter what an intangible asset is, the types, what happens if they're impaired, and then research and development, which really isn't, well, I suppose it has some intangible techniques or intangible parts to it, but I don't tend to really consider it a intangible asset. It's treated differently. It's the only one of these that we're going to talk about today that are expensed as incurred. So some characteristics, of course, they lack physical existence. They're not considered a financial instrument. Normally they're long-term and they have long useful lives, such as patents, I think are 20 years, copyrights, franchises, trademarks, and then goodwill, which is a little, I guess, a unique or special type of intangible asset. All right, so how do we value an intangible asset? If we purchase the intangible asset from another company, perhaps a patent, that we recorded at cost, as well as any cost we have to get the asset ready for use. So like if you buy a patent, there might be some legal fees involved or other incidental expenses in getting that patent ready for use, maybe trip to Washington, D.C. to discuss the patent or to register the patent. All right, and then sometimes we can have an internally created intangible asset. Those are recorded at cost, generally expensed, and only capitalized direct costs. So the example here would be R&D. I don't like to consider it intangible, but it is considered an intangible asset. So an R&D cost would be a good example of an internally created intangible asset. All right. Some intangibles have limited lives. As I mentioned, the patent had a 20-year maximum limited life. So we'll amortize the expense of that patent over 20 years. All right, so you would debit patent amortization and then credit patents. It's $1,000 a year, so $1,000 for each. The useful life should reflect the periods over which the asset will contribute to cash flows. If you believe that patent will contribute positively to your cash flows, then it should be reflected then as a patent expense over those years. Amortization is like depreciation, cost, less residuals, and then there may be impairment. You should probably check the intangible assets once a year for impairment, which we'll talk about in a few minutes. All right, so we do have some intangibles that have an indefinite life, so it might be goodwill, no foreseeable limit on time that's expected to provide cash flows. All right, but they also must, on an annual basis, be treated for any impairment. They are non-amortized because there is no useful life, so we don't really have a value to amortize. All right, so here's just a summary of what we just talked about in the amortization of these assets. Purchase, recapitalized, internally created, such as R&D, we expense unless there's some direct cost, like legal costs, for example, then you can capitalize that particular one. We do amortize it over its useful life, and we do have to use a recoverability and fair value test to test for impairment. For an indefinite life intangible, we just use a fair value test only. Here are some types of intangible assets. Some are marketing related, customer related, artistic related, contract related, technology related, and then goodwill. Okay, so we'll talk a little bit about like artistic related. Probably be something like copyright, Marketing related might be trademark. Customer related probably also would be a trademark. Contract related, a franchise costs. Technology related would be R&D, and then goodwill. So here's examples of marketing with intangibles, trademarks and trade names. Customer related, a client list. If you're going to buy a company, that client list or customer list would be value. Order or production backlogs, contractual and non-contractual customer relationships would also be considered an intangible asset. These costs are capitalized when acquired and amortized over their useful lives. So Green Market acquired a customer list of a newspaper for $6 million. Green Market expects to benefit from the information evenly over a 3-year period. Record the purchase price and the amortization. So $6 million was the purchase price, so we just debit customer list and credit cash, and then we amortize it over 3 years, so $2 million would be amortized, so we debit amortization expense for $2 million and customer list for $2 million. Artistic related intangibles, plays, literary works, musical works, pictures, photographs, which you would probably grant a copyright. Notice they have a pretty long useful life of 70 years, plus the life of the creator. So Walt Disney's life plus 70 years. You see that Disney has held on to all their characters, Mickey Mouse, so forth, because of the length of time granted for their copyrights. Capitalized costs of acquiring and defending, and we amortize to expense over useful lives. So same as customer list, we're going to capitalize it when we buy it, so we'll debit whatever the asset is, plays, and then credit cash, and then plays expense, debited, and credit plays over the useful life. All right, contract-related intangible assets of franchising, licensing agreements such as Subway, McDonald's, construction permits, broadcast rights, service or supply contracts are all examples of a contract-related intangible asset. So if the license has a limited life, 10 years, whatever, when we purchase it, of course, we'll make an entry, debit, franchise, credit cash, and then we'll, at the end of the year, we'll make an adjusting entry and amortize it over the 10-year life. Adjusting entry, debit amortization expense, credit, franchise. All right, if the franchise has an indefinite life, then since there's no definite life, we don't have a value to amortize it, so it will not be amortized if it has an indefinite life. Technology-related patents, trade secrets, R&D. So patents give you exclusive use of that design or architecture plan for 20 years, and we'll capitalize the cost. We buy that patent, debit patent, credit cash, say $100,000, and then we'll, for $5,000 a year, right, we'll amortize it over 20 years, as long as it's providing cash flow over those 20 years. R&D costs are expenses incurred if those are used in developing a patent, and then we'll amortize it over legal or useful life, whichever is shorter. Argot incurs $180,000 in legal costs to defend a patent. Patent's useful life is 12 years, amortized on a straight line basis. So the legal fees and amortization can be charged to patent. The legal fees, can be charged to patents, and we'll credit cash, and then we'll amortize that over 12 years. So we'll debit amortization expense and credit patents for $15,000. Other types of intangible assets, goodwill. So conceptually, you think about this, it relates to the economic benefits arising from the assets acquired in a business combination, a merger, or purchase of a business. Only recorded when an entire business is purchased. So you have to record 100% of that business to record goodwill. So goodwill is measured as the excess of the purchase over the fair market value of the net asset. So you're paying a premium for this business because you think it's worth more than the fair market value of its assets. All right, so here's a little example of how we record goodwill. We decide that we need a parts division to supplement our existing tractor distribution. The president of Multi-Diversified is interested in buying tractoring company. The illustration presents a statement of financial position of tractoring company. All right, so here's the, target company, and they have assets of 255 and liabilities of 55. So you can ignore the equity for goodwill computations. So to record goodwill, we first need to determine the fair market value of the assets, net, so we subtract out liabilities, and those are $350,000 from the information given. All right, and then we decide to accept the offer of $400,000. How much is the goodwill? So the fair value of the assets identified were $350,000. All right, and the value assigned to goodwill, fair value less purchase price, which is $50,000, and the purchase price of $400,000 would be the amount that we debit for this new business. So here's how we record it. We'll debit all the assets, and notice they're debited for the fair market value of their costs. All right, and then as we computed earlier, goodwill was 50. We'll credit liabilities and credit cash for 400,000. Oops. So there's that one. So credit cash for 400,000. All right. So here's another example. Global purchase and net assets of local company for 300. The balance sheet prior to acquisition is shown as follows. We show both cost and fair market value. So the fair market value is 200. Remember, we show that at net. We take total assets and subtract out your accounts payable or all of your liabilities. They just happen to have one. So the book value is 130. Fair value is 200, as is shown here. And so then the purchase price is 300. So our goodwill would be 100, the amount that we paid over the fair market value of the asset. This is a revaluation that when we record the book value numbers, it'll actually be recorded on the purchaser's books, who's purchasing the target company, will be recorded. The assets will be recorded at 200,000. All right. So fair market value of the assets are 200, purchase price 300. So goodwill then is 100,000. All right, so record that. Record the assets at fair market value. We credit accounts payable and credit cash. Goodwill is considered to have an indefinite life, so it's not going to be amortized because we cannot find an amortization value per year because we don't have useful life. We only adjust the carrying value of that asset, the goodwill asset, if it is impaired. A bargain purchase is when we purchase a price less than the fair value of the assets. Maybe a company is going out of business. In this case, we don't record goodwill, but we just record the difference between the fair value and our price, and the fair value is going to be higher as a gain by the purchaser. All right, let's look a little bit at impairment of limited life intangibles. So if we think that, for some reason, the future net cash flows is going to be less than the carrying value of the asset. So we have a patent and say the carrying value is 200,000, but cash flows are only going to be 150. So that might be a situation where we have an impairment. All right, so if the sum of the expected future net cash flows is less than carrying amount of the asset, we have an impairment, and that's called the recoverability test. The second is if the impairment loss is the amount for which the carrying amount of the asset exceeds the fair market value of the asset, so that's the fair value test. Loss is going to be reported just as part of your regular income from continuing operations items. So let's look at an impairment case with a patent. So we bought a patent for $60 million, but we did some testing, and this is a recoverability test. So as part of the recoverability test, we did some testing. We found that the future net cash flows are only $35 million, and that's discounted future net cash flows are only $35 million, carrying value is $60 million, so we have an impairment of $25 million, and we'll have to record that as a loss. Here's how it's shown. This is a different one, using fair market value, fair value test. So carrying amount of the patent is $60 million. We did a fair value test, hired some experts and said, fair market value is only $20 million. So the loss on impairment is $40 million. So we'll debit loss and credit patents for $40 million. We're not able to recognize restoration of any previous recognized impairment loss. So in other words, once you take the loss, it's permanent. Impairment of indefinite life intangibles other than goodwill should be tested at least annual, and we'll use a fair value test for that. So fair value is also carrying amount, that's your loss. No recoverability test if it's an indefinite life intangible, that's not goodwill. All right, so here's another example of impairment. We have Archon Radio, purchased a broadcast license for $2 million. Archon Radio has renewed the license with the FCC twice at a minimal cost. Because it expects cash flows to last indefinitely, Archon reports the license as an indefinite life intangible asset. Recently, the FCC decided to auction these licenses to the highest bidder instead of renewing them. So Archon expects cash flows for the remaining 2 years of his existing license, so 2 more years of revenues. It performs an impairment test that determines the fair value is $1.5 million, but the carrying value, or the cost that's left, right, book value not yet amortized, is $2 million, so the loss on impairment is $500,000. So two-step process on the impairment of intangible assets. First step, concerning goodwill. Concerning goodwill, 2 steps. Fair value is less than carrying value. Then perform a second step to determine possible impairment. Determine the fair value of the goodwill, implied goodwill, and compare it to the carrying amount. So let's take a look at that. So Colberry purchased one division, Brit Products, for $2 million. Colberry management is now reviewing the decision for purposes of recognizing an impairment. So this illustration lists their net assets, including the associated goodwill. And so goodwill is $900,000, and then we have net assets, including the goodwill, of $2.4 million. So step 1, the fair value of the reporting reporting unit is below carrying value. So the fair value is $1.9 million. Write down what I told us that. So that's just a given. The fair value is $1.9 million. Carrying amount, though, is net of goodwill. So we take this balance sheet, subtract out this $900,000, so $1.5 million. They're not going to count twice, so $1.5 million is our net assets. So our implied goodwill is $400,000. Carrying value is $900,000, so the loss on impairment is $500,000. So we'll just debit loss and credit goodwill like we do for any other intangible asset. So this is just a summary of his limited life intangible asset. We do recoverability test, then the fair value test. Indefinite life other than goodwill, and we're just going to use fair value test, and then goodwill is 2-step process. The fair value test on the reporting value, than the fair value test on the implied goodwill, which was, I think, 400,000. This is, yeah, implied goodwill, yeah, it was 400,000, just the difference between the fair value and the carrying value on step 2. Okay, so presentation, and we'll skip up to here, and this is showing how intangibles are shown on the balance sheet and income statement. There's probably going to be on the balance sheet notes related to those intangibles to give the users of the financial information more detail. And then R&D. R&D costs really are not in themselves an intangible asset, but we cover them as part of, as I mentioned earlier, it's really not intangible. Frequently result, but they do frequently result in other intangibles like patents and copyrights. We have new products and processes. Here's an example just of how much companies pay for R&D compared to sales, and Facebook's the most, apparently, that R&D is 21.39% of sales. All right, and then finally, this just gives you some examples of research and development. So research is kind of science, laboratory stuff. Development is where you're taking something from the research, conceptualizing it, and putting it into some kind of process design or product design. Here are just some examples of costs associated with R&D activities. And these are research and development costs, so material, equipment, personnel, contract, and direct costs. And then this is just research and development costs as well. So that's similar to R&D costs, startup costs for new operation and initial operating losses, advertising costs, computer software. Okay, so that's the difference between the R&D costs and the R&D activities. So here's our R&D activities, and then here's our R&D costs related to those activities. All right, and then here's how it's presented. Expense as incurred unless there might be some capitalized costs. All right, that's all I have for you. So have a good week, and I'll have all this stuff up Friday so that you have a week, or up to a week, I guess, to work on it. As I mentioned, and I'll put more on Blackboard, but your final will have 2 windows, one on Thursday and one on Friday.